Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello, and welcome to Forecast Update Live, a video series from Everag Insights, where each month we'll gather to discuss our dairy market forecast. I'm your host, John Spainhour. We're joined today by Erica Medke, Matt Gould, and Phil Plord. To get us started, Erica, run us through the highlights of this month's forecast and how that might have changed from last month.
Good morning, John. Excited to be back for another month of forecasting. In general, our bias is higher as we look at our forecast numbers. Cheese, we've taken the next couple of months up a few cents. And then as we look at the butter curve, we're also moving that a bit higher for the rest of the 2024 season. Other than that, whey, non-fat, largely unchanged.
Thanks, Erica. Every month, we ask our panelists to take either the bull or the bear case of the story. This month, Erica has agreed to take the bull case. Erica, take it away and let us know what's bullish about our market.
Thanks again, John. And I think I got the easier end of the stick this month because, as I just mentioned, we're a little bit more bullish on our forecast in general. I would say a big factor behind that is milk production, and in general, continue to see negative year-over-year numbers across the major milk producing regions in the world. So we've got the European Union in general feeling a little bit slower. Now they were up a 0.5% in March, but in general, the components are down there. So I think there's a general sense that the peak is off of spring flush. We may see a little bit more milk stretch into it. But if you recall, about 3 months ago, our folks at Fresh Agenda had put up the warning that we had the possibility for a strong European flush. I don't think that's going to materialize due to the weather as it's materialized so far this year. In the U.S., we continue to see negative year-over-year numbers. New Zealand also in the negative territory. And I do want to caution that we do have some risks coming up as we think about avian influenza. That is continuing to spread across the United States. And while we didn't see a huge impact in the month of April, I would say that continues to be a watch out and a risk factor for the entire industry as we think about milk supply here in the US. The other piece is it's summertime. And yes, we have heat every year, but as you look at the temperature maps and the forecasts, it's going to be a hot summer. That's not good for milk production across the United States. And the outlook is for extremely warm weather from the Texas, New Mexico, all the way up into Idaho. So that outlook is for hotter than average. Big dairy regions there, less milk supply. The other piece to note, just in the general dairy space, is that we are seeing additional promotionals, features, specials. A lot of retailers, restaurateurs are recognizing that there are consumers out there that are really driving for value, and they need to provide that value to keep that customer traffic. We've seen McDonald's, Walmart make some big splashes in terms of features, promotions, reducing that everyday low price, and others copying that, following suit, creating their own special values. So that definitely has the potential to drive, especially a lot of cheese demand, as we see a lot of these features having cheese prominent at the center of the plate.
Thanks, Erica. I appreciate your outlook. Matt, you've taken the bear side of the story. What's bearish out there that we should be keeping our eye on?
I think, although I have the bear side of the story, I think near term, Erica certainly wins the day, especially as it relates to supply. But I want to take a longer term view and wave a flag. Historically, it takes 6 months of profitable margins to trigger expansions in the country. May was the 9th consecutive average profitable month. June will be the 10th. So if we look at history and how long it takes to trigger a milk supply expansion, we're due. I think as we stand today, when you talk to producers, they'll tell you, there isn't a lot of milk around. It doesn't stay that way forever. And adding to that, I want to remind our viewers that a year ago, in July of 2023, milk production was down by 1%. And during that month, milk per cow also decreased. Looking ahead, we're starting to move into a territory where we are having easy to beat comparables and a market that has gotten used to the U.S. being in contraction territory. It could be surprised by more supply, especially as we get deeper into the year. The August, September, October, very real possibility of growth is ahead of us, even as we sit today with extreme heat. We also have all these cheese plants coming online. For many of those cheese plants, they've coordinated with farmers to build greenfield sites. And so we know that we're going to have those new greenfield sites populated with additional cows. So we will have a milk supply response. It may not be here today, but it's certainly coming in an environment where we've had a really poor demand, generally speaking. That specter of milk growth could wreak havoc on the market. That's supply, and I'm not sure that I'm doing a very good job of being bearish for right this moment, but I think at least waving the flag for as we get deeper into the year, certainly that would be the bearish view. And then separately, as it relates to exports, what we experienced in March and April is we had very subdued prices for cheese that won us export orders. And now that we've seen cheese prices rally, I expect that those cheese export orders are drying up. That has been a feature of the marketplace for the last more than a year. I don't know. It's been some time where when prices were low, we got exports. And then as we rose, they dried up and then our cheese prices fell again. I think that dynamic is still in place. And so although we are, in the midst of a cheese price rally as we speak, that downward pressure from exports is a significant risk or bearish risk to the marketplace. Bigger than U.S. exports, total worldwide exports for dairy, we're still seeing are struggling to find traction. And specifically related to China, I don't want to go deep into China on this video, but we are still seeing issues out of China. When China catches the flu, we all catch a cold. That certainly exists today.
Thanks, Matt. So here in the immediate short term, not the biggest bear case, but longer term, looking forward, there's reasons to be bearish these prices.
Exactly.
Thank you, Matt. Every month, we take an opportunity for Phil to give us a look at his favorite look, where he just does a wonderful job of showing us something new and interesting about the marketplace. Phil, what do you have in store for us this month?
Yeah, the favorite look in this month's forecast update concerns quick service restaurant price inflation. The people at Zero Hedge, the website, they had this really interesting data set one day showing changes in prices for 5 items at each of McDonald's, Taco Bell, and Chick-fil-A today versus the end of 2019, so sort of pre-pandemic levels. And when we wonder about the angst amongst consumers about high prices, and we hear somewhat disappointing results from a lot of these restaurant chains over the past several months, these numbers put in pretty stark relief what's been going on and why maybe people have been, and have backed off. McDonald's has pushed back against some of these numbers saying, hey, it's certain franchisees, and I don't know that we can claim these are gospel carved in stone, but directionally they make sense. Chick-fil-A chicken strips, $7.85 today versus $4.39 at the end of 19. Prosaic, very simple McDonald's cheeseburger was on the dollar menu at the end of 2019, as much as $3.15 at certain outlets here recently. So Zero Hedge found McDonald's 100% plus inflation on the 5 items, Taco Bell 57%, and Chick-fil-A 80% increase in prices. And so if you believe that prices matter, we've certainly seen a lot of inflation in quick service. And I think we've all, right? We've talked about it. The people in this group have said, wow, I went to, such and such the other day and it cost me $12 and I didn't even get fries. And when we wonder about consumer malaise, consumer angst, and slow demand from the restaurant sector, this is why. And to Erica's bull case point, we are finally seeing a reaction with, hey, we're going to promote value meals. We're going to do some different things differently to try to drive traffic because the consumer has had enough.
Well, Phil, I can definitely say as a father of 2 girls under the age of 10, I'm an avid consumer of the quick serve restaurants that you spoke of on the weekends. And I have been very sensitive to that price just because of the business we're in. And I've been blown away by some of those pricing.
You notice.
You do notice. And that's even at those restaurants. Go to some of the higher end restaurants, and I think it really starts to inflate from there. Thanks, Phil, for that look. That was great. That'll do it for this month's episode of Forecast Update Live. Thank you to all of our panelists. Thank you to everyone on the EverAg Insights team for their work on the forecast. And thank you, the viewers, for tuning in. If you don't receive our forecast update and would like to subscribe, please reach out via email at insights@ever.ag. If you like this video, be sure to subscribe on our YouTube channel, give us a thumbs up, and share with a friend. We'll see you for next month's edition of Forecast Update Live.